Billionaires are quietly dumping stocks and buying gold, not as a strategy shift, but as a full-blown exit plan before the average investor even realizes what's coming. While everyday traders are still celebrating the S&P hitting new highs, the most powerful investors in the world are preparing for a financial reversal that could wipe out trillions in paper wealth. And they're not just hedging, they're reallocating in silence, positioning themselves on the other side of the coming collapse. The question is, what do they know that you don't? Let's start with the red flags on the surface. The S&P 500 and NASDAQ may be surging, but under the hood, market participation is dangerously thin. As of this week, just 7 tech stocks are responsible for over 60% of the market's total gains. That's not a rally, that's a distortion. It means the broader market is stagnating while a handful of names inflate the illusion of growth. And billionaires know exactly what this means. We've seen it before. This is the same dynamic that triggered the dot-com bust in the subprime crisis. When markets get top-heavy and disconnected from fundamentals, smart money moves first, quietly, before headlines catch up. But this time, they're not just rotating out of stocks, they're running to gold. According to recent filings, major family offices and hedge funds have increased their gold exposure dramatically in the last quarter. Bridgewater, Soros Fund Management, and even BlackRock-linked private portfolios have expanded their positions in physical metals and mining ETFs. Gold ETFs like GLD and IAU have seen sharp inflows, but here's the real story. Physical gold purchases are exploding. Private vault operators in Zurich, Singapore, and Dubai are reporting record storage demand from ultra-wealthy clients. We're talking pallet-level transactions, not coins, not bars, but tons, and it's all happening off-market. And here's the open loop. What exactly are they preparing for? To understand it, you have to connect 3 invisible signals. First, the yield curve remains inverted, and has been for over 300 days. That's the longest inversion since the early 1980s. Historically, this is one of the most reliable indicators of a coming recession. Second, use how commercial real estate is cracking. Vacancy rates are climbing, refinance deals are collapsing, and regional banks, the backbone of real estate lending, are being forced to write down billions in toxic exposure. Third, the Federal Reserve is trapped. Inflation remains sticky, but rates are too high to sustain without breaking the credit markets. If the Fed cuts, inflation reaccelerates. If they hold, credit dries up. Either path leads to instability, and billionaires are betting on both. They're not timing the top, they're evacuating before the exit signs light up. And this isn't about fear, it's about control. Gold gives them full sovereignty, no counterparty risk, no exposure to leverage, no digital fragility. And here's what makes this different from the past: the level of quiet coordination. In previous cycles, gold was a fringe hedge, symbolic play, but in 2025, it's become a core allocation. Even central banks are loading up. According to the World Gold Council, global central banks added over 1,000 metric tons of gold in 2024, the highest annual accumulation on record. Why? Because they see what's coming, a multi-systemic correction, one that involves equities, currencies, and geopolitics all at once. And while gold may seem like an old-world play, it remains the one asset that bridges both the analog and digital eras. It has history, scarcity, and universal trust. And in a world of manipulated fiat and experimental currencies, trust matters more than ever. Most people think billionaires invest differently because they have better information. But that's not the full picture. They operate on a different horizon. They don't chase hype. They rotate years ahead of the news, and they do it quietly. In late-stage markets, silence is a strategy. That's why the media isn't reporting this shift. It's not viral, it's not clickbait, it doesn't sell ad space. But behind closed doors, massive asset managers are cutting equity exposure and parking value in gold, silver, land, and other real stores of wealth. And when the next wave hits, whether it's a credit collapse, a Fed policy misfire, or geopolitical escalation, the damage to retail portfolios will be brutal. Just look at what happened in 2008. The stock market lost over $7 trillion in household wealth. Meanwhile, gold soared from under $700 an ounce to over $1,900. Right now, gold is trading near $3,336 per ounce. And with real interest rates turning negative again, the upside potential is real. But this isn't about price targets. This is about what gold represents in the current cycle: exit velocity. The ability to hold value while everything else falls apart. Wall Street pushes optimism. The elite quietly exit. They're rotating into quiet assets, real stores of value, and they're doing it before the window closes. Let's close the loop. Earlier we asked what billionaires know that you don't. Now you do. They see the signals. Yield curve inversion, credit strain, Fed policy deadlock, and the fragility of inflated tech markets. And they're responding with the one move that always comes before a storm: capital preservation. This isn't a conspiracy. It's a coordinated retreat from paper wealth. And gold is their firewall. If you're still all in on equities without a hedge, you're not investing. You're gambling on calm in a building that's already on fire. The elite aren't waiting for headlines. They're preparing for the reset. The only question is whether you will too. But what if this gold rotation is just the first phase? Here's where the next layer of risk emerges. Several billionaire-backed think tanks are now modeling currency regime change, not decades away, but within this cycle. The focus? Replacing debt-based fiat systems with asset-backed alternatives. Gold is step one, but what comes next is even more telling. Private tokenized assets, energy-backed units, and regional digital currencies that bypass the US dollar entirely. Think about that. If a parallel financial system is being constructed behind closed doors, one where gold is reintroduced as collateral, then this current rotation isn't a hedge. It's a migration, and while Wall Street analysts are still debating whether inflation is transitory or sticky, the smart money is already betting on systemic fragility. They're running stress tests the public never sees. They're prepping balance sheets for a liquidity freeze that hasn't hit the headlines yet. Just look at the UK's 2022 pension crisis. Trillions nearly vanished overnight before a last-minute bailout. Now imagine that happening in a much larger, more leveraged US market with far more global spillover. That's why gold isn't just an inflation hedge anymore. It's an institutional firewall. And here's the final trigger no one wants to talk about: confidence erosion. Markets run on belief. When confidence cracks, safe haven panic follows. That's when price doesn't matter. That's when narrative dies and survival takes over. And that's what billionaires are gaming out right now. They're not hoping gold will go up. They're positioning in case everything else goes down, fast and without warning. And gold still carries that trust across borders, across time, and across regimes. So while retail speculators chase meme stocks and AI fads, the smartest capital on earth is stepping away from the noise and into clarity. This is not a market call. This is a signal of strategic retreat. And now that you see it clearly, you have two options. You can pretend this wave won't hit you, or you can prepare like the people who are already surfing it. The choice, as always, is yours. If this opened your eyes, subscribe to Wealth Signal, where we track what billionaires do before the media catches up.